Stock Market Investing 25 Tips for Beginners. Written by Giovanni Richters. Narrated by Ron Garner. Introduction. You've been thinking about investing in the stock market, but don't know where to begin. There is too much information about investing, and it is quite daunting if you don't know where to start. This is where 25 Tips on Investing for Beginners comes into play. We will look at common topics that you will come across while you take your first steps when it comes to investing. Getting confident and knowledgeable is the highest priority before you start your investing journey. Just keep in mind that you are not alone. Every year, there are many new investors who take this jump towards a better and more financially stable future. 25 Stock Market Investing Tips. Before you start investing, you might have a couple of questions or concerns. I've listed 25 of the most common things I've noticed from new investors and how to set yourself up for success. Let's get started. Write down your goals. If you don't know where you are going, there is no need to even get started. Make sure to write down your investing goals and be specific with the timeline. Do you want to have $500K in your retirement account in 15 years? Or do you want to have $1 million in 10 years? What will your investment strategy be to acquire this wealth? And what will your portfolio mix of securities look like? Will your portfolio consist of 70% stocks, 25% bonds, and 5% cash? Writing down your goals will give you a clearer picture of what you want to accomplish and how to do it. Start investing early. The earlier you start investing, the faster will not only your money grow, but you'll also be able to retire quicker, depending on your financial goal. How early should you start? When you get your very first job. It does not matter if this is a retail job or one waiting tables at a restaurant. You want to get into the habit of thinking about your future now and setting aside money to invest so you won't have to work for the rest of your life. Starting your investing journey at an early stage in your life also has the benefit of seeing how your money grows, which will give you the confidence to invest even more. Inflation eats away at your money. You might refrain from investing in the stock market because you heard how risky it can be and how many people have lost a lot of money in it. But keeping your money under your mattress or even in a savings account is also very risky because of inflation. Inflation is the rise of the cost of goods, which lowers the value of money. A chocolate bar today might cost $1, but next year it could cost $1.05. So that same dollar you have today is worth less in the future because it has declining buying power. The stock market allows your money to not only keep its buying power, but it also has the possibility to grow your money faster than inflation. Do your research. It's not only good, but necessary to do your research to see what businesses and companies you are investing in on the stock market. Almost everything you need to know about different stocks, bonds, and mutual funds can be found for free on the internet. I would refrain from paying any money to get stock market information. Last thing you want is to invest in a scam or a company that is losing money and not making a profit, which could cause you to lose money in the long run. This happens to a lot of unsuspecting investors. To start doing your research, all you would need is the ticker symbol of your investment to get started. A ticker symbol is the abbreviation of the company, mutual fund, index fund, bond, etc. on the stock market. You can then use a site like Morningstar.com to do your research. Create your own rules. Good rules in investing give you boundaries to work in. If you have a rule not to invest in any company without doing some research on it first, you will save yourself a ton of headache. No one will be able to scam you with hot stock tips they have heard through the grapevine. This is how many people get scammed and bamboozled. Good rules give you a level of confidence when you invest. It gives you that extra push when you are hesitant when buying new stocks or investments. They give you structure and a blueprint to stick to. You can start with simple rules and add more complex rules once you get more experience with investing. Example of rules: 60% of my investment portfolio will consist of stocks. I will only invest in companies who have been able to increase their earnings by at least 5% for the last 10 years. I will rebalance my portfolio yearly. Don't listen to everyone. Be wary of who you take advice from. Some people, especially in the media, receive financial incentives in order to tell you what to invest in. Also, family and friends could give you bad investing advice if they heard about a hot stock tip at their job without doing any research first. Keep in mind, just because you heard of a popular company or use its products does not mean it could be a good investment. Many companies on the stock market never turn a profit. A popular company, like Tesla, that trades on the stock market under the ticker symbol TSLA, is still not profitable. Even though it's bringing in an increased amount of revenue, its net income is still in the red. Constantly educate yourself. I've always told myself that if you are uneducated on a topic like investing, then people will probably take advantage of you. It's very easy to set up an investment account with a big bank or even a retirement account at your job, but you should know what your investment options are, what you will be investing in, and what types of fees you will be paying. Nickel and diming you on fees could end up costing you thousands or even hundreds of thousands over your investing journey. You should also have a basic understanding of how stocks, bonds, mutual funds, index funds, and other investment vehicles work. See 3 examples below. When you purchase a stock or share, you are buying ownership in a company. Big companies like Apple have shares outstanding in the billions. So, when you buy just 1 or 2 shares of stocks, you only own a very small piece of the company. Bonds are like IOUs that a company or government entity gives to you after buying the bond. When you buy a bond, you are going into a legal contract that states that not only will you get your original money back, you will also receive frequent interest payments. A mutual fund is a fund that pools different investors their money and invests this in a variety of securities. Have savings. Always have some money saved up for emergencies. Never invest all of your money. There is always a risk that you could lose all your invested money. Make sure you have some money saved for emergencies, housing, entertainment/food, to start your business and college. Don't forget that life is not predictable. Your car might break down, or you could get into an accident, costing you much in medical bills. You can never be prepared, but you can have some money set aside. Diversify your investments. Don't invest all your hard-earned money in one company. That's extremely risky, unless you are a risk taker, big risk, big reward type of person. Make sure that the money you do invest is diversified, meaning that you don't have all your money invested in one stock. A mutual fund could be a good solution for you. Mutual funds allow you to pool your money with other investors and invest it in a variety of securities. About a decade or 2 ago, there was a company called Enron that went bankrupt after it was found out the company was lying about their earnings and profits. Many employees of Enron had all their retirement money invested in the company. When Enron went bankrupt, many employees end up losing their retirement income. Also, imagine being in your 50s and your investment goes up in smoke. That's why it's always smart to diversify. Don't be emotional. Investing can be a literal, emotional roller coaster ride. The daily up and down ticks of the stock market can easily make you go crazy. One way to overcome this fear is to invest in what you are confident in. This confidence comes with knowledge, patience, and time. Knowing and accepting that investing has risk associated with it and you could lose money prepares you mentally for any downswings you might see happening in the stock market. Don't rely on luck and miracles. If you look at the stock market as your way to get rich fast, then you could be setting yourself up for failure. Don't get me wrong, it is possible to take $10,000 invest it, and turn it into millions because it has been done before. But this investing strategy is extremely risky, and most people are better equipped to mentally handle the longer and slower process of getting wealthy. Assume that you can lose it all. If I can lose it all, why would I invest in the first place? Well, there is a reason why I added this tip. First of all, you're not supposed to have all your money in the stock market. When you are younger, you can take more risk because you can bounce back from early losses. But when you are at your retiring age, you should think about investing in more conservative securities that might not increase in value as fast as stocks, but they will keep your money from not depleting. Two of these securities are bonds and annuities. Have side hustles. Besides having a job or career and your investments, what else are you doing to bring in some additional money? In today's society, job security is at an all-time low, and many people are either unemployed, underemployed, or working part-time to pay the bills. It's in your benefit to have some additional money streams. You could work part-time to make some extra money, but the main ones to think about are investment properties, dividend stocks, royalties, for example, from book sales, and your own business. If you have a passion like photography, drawing, or video editing, you can do some freelance work on the side and possibly turn it into a full-time venture. Always keep your eyes open for opportunities. The best time to start is right now. I always get complaints from older people that they have missed the boat and they are too old to start investing. This is not true at all. It does not matter if you are 20 or 50. It's very important to invest, even if you start with a small amount. There is always opportunity to make good money in the stock market. However, that does not mean you should start day trading with the money you do have invested if you are older in order to catch up. This is just a recipe for disaster, as you will be way too emotionally involved to make the right trading choices. Dividend investing. I'll let you in on a little secret. I only invest in dividend-paying companies which increase their dividends faster than inflation. Dividends are earnings a company pays out to their shareholders. In order to get a dividend, you need to own at least one stock in a dividend-paying company. These dividends not only increase my wealth over time, they also give me peace of mind because of their steady stream of income. I not only enjoy the dividend, I also see my stock increase in value. Now, I only buy these stocks when they are undervalued, which means they are trading under their market value. Examples: Realty Income, McDonald's, T. Rowe Price. Growth investing. A growth investor is an investor who likes to buy low and see their investments grow. They eventually sell at a higher price than what they bought their investment for. The majority of investors are growth investors. Technology stocks are good stocks to keep an eye on because these tend to increase in value very fast. Examples: Facebook, Oracle, Microsoft. Start small. One complaint I hear is people telling me, if I only had $1 million, I could start investing. Not only is this not true, because you can start investing with as low as $10, it is also recommended to start small. The biggest reason to start small is to get comfortable with investing. If you started by only investing, let's say, $100, you can see your money constantly rise and drop. It's fun to look at in your investment performance daily. You will also start to gain confidence and knowledge to invest smarter, which will lead you to invest bigger amounts. Now, let's look at that from the other end. Let's say you inherited $1 million and you have the task to invest this money. You have never invested before because you always told yourself that you needed more money, and now you finally have it. Guess what? You will be too scared to invest $1 million. You don't have the expertise and the know-how. If you started out investing smaller amounts for years and suddenly got this $1 million deposited in your lap, you will have the confidence to invest this amount because you've already seen what works and what does not while you were investing small amounts. Live your life. Never let the stock market control your daily life. The daily up and down swings of the market has an effect on plenty of investors. When the market is at an all-time high, investors feel good, go to work in a good mood, and go to sleep with a clear mind. But when the market tanks, many investors feel like they just got kicked in the stomach. They are sad, angry, irritated, and just in a very bad mood. Also, don't become so frugal that you only want to invest all your money in the stock market, and tell yourself that you will live a fun life when you are retired. If you want to go on a vacation or buy yourself something nice, go ahead and do it. Stick to what makes you comfortable. Everyone has their comfort zone when it comes to investing. Some people are risk takers and would do well investing in penny stocks or day trading. Other investors are more conservative and would rather invest in securities that are not too risky and which allow them to preserve their wealth. Always stick to what is comfortable to you. If you do not like to analyze and choose individual stocks to invest in, it's probably best to invest in mutual funds or index funds. If you are someone who would rather not invest on your own and need some help, an investment firm that offers a full brokerage service is probably best for you. Just make sure to always push yourself to learn more about investing, because at the end of the day, this is your money, and you are ultimately responsible for your retirement. Have fun. I'll be the first to tell you that investing can get quite boring and uninteresting. Some people just don't like to analyze companies and look at financial numbers. You should try to figure out what you like most about investing and hone in on that specifically. Maybe you like to see your money grow, or maybe you like to see your dividend income increase month over month. You might also like other ways to make money, such as selling short or options trading. Whatever it is, try to have some fun with investing. Use technology to your advantage. We are very lucky that we can use our laptops or even a small device like our mobile phone to buy investments or to research stocks. The advancement of technology has also made it very affordable and fast to buy investments. This means you can trade shares of stocks no matter where in the world you are. All you need is an internet connection. In the old days, you have to call your broker and pay a very high commission in order to put in an order. Nowadays, you have apps like Robinhood that are commission-free. You also do not have to sign up for a full brokerage account. You can go with a discount broker like Ally.com that has low trading fees. Study the greats. Warren Buffett, Benjamin Graham, Charlie Munger. Make sure you read books on investing billionaires, how they amassed all their wealth, and what they do to maintain it. This will get you in the mindset of how the very rich think and conduct themselves. It will also show you how some have turned small amounts of cash into big wealth. Everyone likes a rags to riches story. Don't fall in love with your investments. Every investment will be sold if it is not performing how it should be. This is one of my personal rules. I do not get my personal feelings mixed with investing. It's fun to tell your family and friends that you own Disney or even Pepsi stock. But if these stocks don't make me any money, I end up selling them. This is why I like to analyze a company's financials, annual reports, to see if they are still financially sound. Know what you are investing in. Before you follow anyone's advice, especially from any financial planners, make sure you know what you are investing in. There are many scammers out there who would like nothing more than a clueless person they can take advantage of by using some industry terms in order to sound educated on the topic. If you are investing in a mutual fund or even an ETF, make sure you get the ticker symbol of this entity to do some research on the companies you are investing in. Some investors don't like to invest in weapon companies or prisons, but if you are investing in popular index funds, you are more than likely also investing in these institutions. Also, if a company is not conducting themselves ethically, would you still want to invest in them? Break the rules. I just told you to create your rules, and now I'm already telling you to break those rules? Yes. Here's why. You should always experiment with your investing strategy. It is good to have rules, but every now and then you might have to break them. Investing should be fun, and if you are stuck to rigid rules, it could become boring very quickly. The trick is to break the rules, but take small risks. For example, you want to start investing in cryptocurrency, but you have a rule not to invest in high-risk securities. You have a gut feeling that you will do well with this investment. Go ahead and buy a small amount of cryptocurrency. Don't go all out and spend 50% of your portfolio in buying this currency. Share your knowledge. Once you have some knowledge under your belt from investing in the stock market, you have your golden rules, and you are confident in your investing skills. You should share your knowledge with others. You can start by educating your family and friends to get them comfortable with investing. It is very surprising that there are many misconceptions about investing, and many people have been burned multiple times investing in wrong stocks. This usually ends up scarring them for life, and they will not lay a hand on any investments anymore. This is where you can come in and show them how you have been successfully investing. Believe me, it feels good to be able to help a family member and secure their financial future. Talking to people about your experience with investing will also allow you to meet like-minded investors who will take your investment skills to the next level. Resources. Following is a list of free internet sources you can use for research. Morningstar.com, Guru Focus, StockCharts.com, FinViz.com, Finance.yahoo.com, Google.com/finance. Keep in mind just to use the free version. Important disclaimer. This book is presented solely for educational and entertainment purposes. The author is not offering it as legal, accounting, financial, investment, or other professional services advice. The content of this book is the sole expression and opinion of its author. It is not a recommendation to purchase or sell equity, stocks, or securities of any of the companies or investments herein discussed. The author cannot guarantee the accuracy of the information contained herein. The author shall not be held liable for any physical, psychological, emotional, financial, or commercial damages, including, but not limited to, special, incidental, consequential, or other damages. You are responsible for your own choices, actions, and results. Please consult with a competent tax and/or investment professional for investment and tax advice. Copyright 2018 by Giovanni Ritters. All rights reserved. No part of this book may be reproduced in any form or by any electronic or mechanical means, including information storage and retrieval systems without permission in writing from the author. The only exception is by a reviewer who may quote short excerpts in a review. Conclusion. To become a confident and competent investor takes time, patience, constant education, self-reflection, and money. You don't need to be an expert to start investing, and you don't need to have a fancy degree either. This is a benefit, but if you are careless, you might end up making some unnecessary mistakes. Follow the tips I have outlined to get you started on a path to success. It will be a roller coaster ride for sure. At times, you will feel happy, and other times, you will feel down looking at your portfolio. But if you persevere, you will end up prosperous. Thank you. I would like to thank you from the bottom of my heart for coming along with me on this investing journey. There are many investing books out there, but you decided to give this one a chance. If you like this book, then I need your help. Please take a moment to leave an honest review for this book. This feedback gives me a good understanding of the kinds of books and topics readers want to read about, and it will also give my book more visibility. Leaving a review takes less than 1 minute and is much appreciated. Other titles by Giovanni Richters. 50 Tips on Saving Money. Ever have a feeling that you never have enough money when needed? Would you like to have some extra cash to buy what you feel like? Well, in this book, we will look at 50 different tips allowing you to have some extra cash in your pocket and bank account. Smart investors create wealth. It's never too early to start your journey towards accumulating wealth. No one wants to work for the rest of their life. I will show you what wealthy people have known for centuries on how to not only create wealth, but also maintain it so you can pass it down. Thank you for listening to Stock Market Investing, 25 Tips for Beginners, written by Giovanni Richters, narrated by Ron Garner. The end.